traders? This is Robb Reinhold. It is another weekend, but it's another weekend in 2024. Let's jump into it. In this video, we're going to go through the previous trading week. We're going to look at the news. We're going to look at the price action, and it was the first down week in 10 weeks. That'll tell you how big that uptrend has been. We're going to look at the market. We had lots of scoring changes here. We're going to look at all the scoring changes, and then, of course, we're always looking for trades. We're looking to be long the strongest trades. We're looking to be long the strongest stocks and the strongest sectors, looking to be short or bearish the weakest stocks and the weakest sectors. And the stuff that's not going anywhere, we're going to do some sideways options trades on those.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's get ready for the week.
The markets actually had a down week for the first week in 10. So we've had 9 consecutive up weeks. Look, if you got out of a coma and someone said, hey, the stock market's been up 9 weeks in a row, what's the most likely thing that's going to happen? You'd probably say, yeah, it's going to have a pullback. You don't need to know anything else other than that. Now, we did not have a Santa Claus rally. We've talked about the Santa Claus rally, and we've talked about how 2 out of 3 years, the Santa Claus rally has delivered a 1.3% return over those 7 days. The last part of the old year, the new part of the new year. This is the first year since 2015, I believe, that there was not a Santa Claus rally. So whenever we talk about these seasonality patterns, we talk about 2 out of 3 times. This was the 1 out of 3 times. There was no rally. There was actually a decline of 0.09%. And not just that, this is the first time the markets have broken below the 20-day moving average in about 2.5 months. So we will have our first downgrade of the overall stock market score, and we're definitely going to get some downgrades of some sectors. It was a holiday shortened week. This next week will be our first full week. And why did the stock market go down? Look, you could pull out any of the possible ideas, but for me, the fact that the bond yields went up, it made the stock market go down. We've talked about how inversely correlated these are. The dollar end bonds went higher. That's most likely going to send stocks lower. And we close on our highs in the bond market. And we also close on our lows in the stock market. Again, it's telling you there's still probably some selling left to come. Last week on Wednesday, we got the ISM number. The ISM number was slightly better than expected, still below 50, which means contraction. But in that number, the prices paid component plummeted. That was a really good reading of inflation. However, you can see the JOLTS job openings, they've softened a little bit as well. And then we got to ADP and unemployment claims showing, okay, employment's actually holding in quite well. And then on Friday, we got the employment report that also beat estimates. I talked about how 168K and 3.8% was a Goldilocks number. Not too hot, not too cold. This number came out and it was a little hot. And at first, the market didn't like it. The market actually sold off, the dollar spiked, and then all of a sudden people started to think about it and they said, well, what this is saying is the economy is still holding in okay. And then we got the services PMI number right after that this is a very weak number. The services PMI is 2/3 of the economy in the US, and this is weakening down to 50. 50 is no growth, but not shrinking. Below 50, we're shrinking. Mixed numbers, but I think this is kind of what the market wanted, and the market tried to rally. It really tried to rally on Friday. Here's the problem. It couldn't hold the gain. Whenever that happens, it's a sign it wants to go lower. And I said that earlier this week. I said the fact that we can't rally, it's saying this wants to go lower. Let's take a look at some of the trades we talked about last week. I'm going to go through these pretty quick because we have 5 of these trades and I've got 5 new ones for you. So I'm going to go through these quick. We had a diagonal call spread on PEAK peak. 20 was our top. We've got the February, January. So this trade is a mile off. It's doing just what we want it to do. High base is absolutely perfectly fine on this trade. Next up, we were long CVS. I talked about how much I love this pattern, the high and tight base. As a young trader, I looked at this and I said, there's no way I'm buying that. These, I get excited now. So CVS had a 3.1% gain. I personally had a diagonal call spread on this, and I took this off for a decent profit on Friday because I didn't want to roll this going forward. Next up was Emerson Electric. We had a long on this one. We had a 95.98 diagonal call spread, and you can see that it definitely did not do well. It's down 1.8%. We want it near the high end of this range, not the low end of this range. So this trade has a moderate loss on this, but we did get some nice price action on Thursday, Friday. Remember, Thursday and Friday were down days. This stock held in nicely, but this thing has got to move or we've got to exit this and put the capital elsewhere. We had a short on ONON. This is in the consumer sector. The stock was down 1.5%. And in this one, we've got the 25.28 bear call spread. So this is our area of our trade. It is nicely in the middle, but we still want this to go lower. We still have some profit. We got a small profit in the trade. We've got more time on this one to let this thing work to go a little bit lower. And then the last trade, we had a short on Range Resources. We had a 29.31 bear call spread. So this was it. We needed this to go down. We needed this to go down further into the range. It didn't. It stubbornly held up. This one was a small loss. This one was a very small loss. If someone were to take it off early in the morning, it probably would have been a gain if they took it off here. But on this one here, it didn't really go down like we needed this one to go down. All right, let's jump into the current market. And remember, we have a saying at Maverick, trade the market in front of you, not the market you want it to be, or one you think it should be. Just trade the market that is literally there in front of you. Let's look at the numbers. Dow Jones down 0.5%. S&P down 1.5%. Look at the Qs and the Russell. Boy, they got really hammered, but they've also been the best performers. Gold went down because the dollar went higher. And look, oil bounced about 4%. But if you take a look at a chart on oil, it's literally just gained back half of what it lost last week. This is not a great sign for oil, even though the energy sector did have a decent week in the end. Let's take a look at the S&P. This is the S&P chart, and I added in the 10-year government bond. So this yellow line here, this one here, is the 10-year government bond. And this one here is the stock market. Does anybody see any correlation between the two? Or sorry, inverse correlation? Now look, these things are usually inversely correlated. I mean, it's not a surprise that they are. They usually are. But boy, it's been spot on. And when we bottomed out in yields, right here, we also topped out in the stock market. And right now, look at these yields. They are coming back up. We may have some resistance right up above, but it's telling me, look at the slope of that line. It's telling me this thing's going to go higher. It's going to just keep moving here. And then if we take a look at the stock market, yes, we had some pretty big down moves here, but look at these last two candles. These two candles are telling me they wanted to bounce. On each of these days, they had bounced and lost the gain. And then on Friday, we bounced and lost the gain. That's not a really good candlestick to see on the bottom of a pullback. You want to literally see the opposite. You want to see when it falls apart and then recovers and falls apart and recovers. We are now down below the 20-day moving average. This 10-year bond looks like it's got a lot of momentum to the upside. There's no reason to think that this sell-off is over. And in fact, we can go all the way down to 4,600. This is the line on the S&P and still be in a bull market. This is a fully acceptable pullback within a bull market. I do think, again, this market is still a bull market, technically speaking, and that's all we do at Maverick is we trade the technicals. You might have a different opinion. I have a different opinion of what the market's doing than what it's actually doing. I think it should be doing this, and it's not quite doing what I thought it should do. Guess who is wrong? Me. That's right. I am always wrong when the market does something else that I expect it to do. Take a look at the NASDAQ. This thing is even broken worse. And we are solidly below. And look, we are near this support line. And we are looking to get, some bounces here, but all the bounces have failed. They've just all failed. These two candlestick charts are just not great. They're just not great candles to have at the bottom of a pullback. We want to see hammer patterns at the bottom of pullbacks. We want to see bullish engulfing candles at bottom of pullbacks. We don't want to see this. This is not a good pattern. Look, I am not bearish, but what I'm saying is this pullback, when you look at the technicals, it's likely to get deeper. Let's take a look at the weekly heat map. Now I want you to notice where the most intense red is. And remember, we've talked about the January effect where we said the best performing stocks typically have a lousy January. And there we have it. Apple down 6%, Amazon down 5%. Look at just the intense red in the semiconductors. But look around. What's doing well? Look at financials. Hey, financials are doing pretty good. What else is doing good? Look at healthcare. Healthcare is doing amazing. So there are pockets of the market that are holding in very, very nicely. But what is getting hammered right now is the stuff that did the best last year. And again, what do we call that? We call that the January effect. I'm not going to go into it. I went into it last week. But if you want to have information on it, go to last week's trading room. But look, we expect this. We expected this. And I told everyone, hey, I'm not going after the high flyers. I'm going after stuff that's a little bit further down the chain. So let's talk about this week. We are still in a pullback. But that pullback is losing momentum. So if you look at the chart, we had big red candles, and now we're getting smaller red candles. And the market is trying to bounce, but it's failing. It's just telling me that the selling pressure is not as strong as it was before, but it's still stronger than the buying pressure. We are seeing sector rotation. If we really would stripped out like the FANGs, Facebook, Apple, Meta, I can't remember what they are now. They've all changed names. Amazon. If we take those out, the market's probably doing okay. The market's probably flat to slightly up. Those things are just really getting hammered, and that's where the sector rotation is going. It's coming out of those trades and into other trades. If we mirror that, we can actually do really well in this market, even though it's kind of squirrely here. We're still bullish. As long as you're in the things bullish that are actually getting the money, who cares about this pullback? I mean, we're going to take a look at some charts. If you were in the financial sector, this was a great week for you. There were some great trades and some great movements in them. Let's take a look at what is on the schedule for next week, and there's really one thing and one thing only. Thursday morning, CPI. All the inflation numbers have come down dramatically. I don't think there's any real positive that will happen if inflation is at these numbers or lower. I think everyone's already expecting that. I think the big risk is if these numbers come in hotter. I don't see how they can. Every single number that goes into the CPI has been moving lower, but I've seen it where that's happened and then the CPI comes out hotter than expected. We'll just have to wait and see, but I don't think there's much benefit on low inflation, and I think there's risk on high inflation. Again, another reason, I'm just not quite sure this market is ready to bounce off the bottom. I need to see some convincing price action before I look for another leg up. So what has happened? Well, we have gone from a +3 to a +1. That's where we are here right now in the market, a +1 market. On my weekly outlook, I put a 0 because I do expect the first couple days of the week will continue to sell off. I think we have more sell-off to go. I think the S&P could potentially go down to 4,600. At that point, I think there could be a pretty substantial bounce. So I'm at a 0, but I'm at a -2 first part of the week, +2 at the second part of the week. That's where I'm really looking for market direction this week. All right, let's go in and take a look at the sectors and see what changed. All right. As you can see here, the best performing sector was healthcare. Healthcare was the best, utilities the second best, and energy was actually up. I'm getting mildly bullish in energy, and I'm going to show you the chart. I'm going to show you why. But remember the January effect. The January effect. The things that have done the worst tend to do better. Take a look at the biotech sector. The biotech sector was the worst industry group last year. It was terrible. I mean, I want to say the whole industry group went down like 30, 40%. That's huge. And then the rally it's had has been nothing short of amazing. That is why healthcare is up, because again, the money is going into the underperformers. What else didn't do so great at the last part of last year? Energy. I'm really liking the rotation into energy as well. What do I not like? All the stuff that was hot. Tech, consumer, all the things that were hot. I am going to give a little exclusion to communication services. Look at the outperformance relative to technology. So when you take a look at communication services, you're saying, oh, down 2%. That was more in line with the market. When the technology down almost 5%. So if you are going to be bullish in the tech sector, I think you want to be in the communication services style tech sector, not just tech itself. Let's take a look at all of our charts one by one and look at the scores. Last week, utilities was a 0. Guess what? It gets an upgrade. We have now moved up above that moving average. I'm not calling it a 2050 slope as far at this point, but we're going the right way. So utilities gets upgraded. Communication services. I want you to remember this chart, and then I want you to remember what the technology chart with the consumer chart looks like. This chart doesn't look bad. It's actually a +2. We've pulled back to the 20-day moving average, but look, we were really having a good bounce here in comm services. It sold off at the end, but still closed with a green body. That's telling you that it's holding up relatively better than other things. We come next to real estate. Real estate was a +3. We've come down to a +1. And look at the candle on Friday. It was a green candle, but we're still drifting lower. So I still think there's a little bit more downside here in these sectors. We come over here to healthcare, and guess what? Healthcare just went sideways on the weekdays. I mean, it went up on Tuesday. And remember, Wednesday, Thursday, Friday weren't great days. Guess what? You didn't care. This is where the money is going. It's where it's rotating. Next up, industrials. I was pretty excited about industrials, and I've got to be less excited about them. We pulled back. We're at a +1. Really looks exactly like the market. We're just holding under that 20-period moving average. Until we get a nice bounce off that, I can be mildly bullish at best in industrials. Here we come to another one. Look at this sector. If you are in this sector, you had a great week. You had an absolutely great week. I talked about a trade in MetLife on Thursday. MetLife went up like 3 or 4% on Friday, totally ignoring what the market was doing. This is the best looking sector out there. This is absolutely the strongest sector, the financial sector. Take a look at consumer. Consumer, look at that pullback. And look at these candles at the end of the week. They're still drifting lower. Yes, we're trying to put together a little bounce, but they're still drifting lower. Remember what the financials look like. It looked like everything's honky-dory. And then we come to tech. And now we start to see even weaker candles. I mean, look how close we are to the 50-day moving average. And we had red candles. At least the consumer sector had green candles. This one had red candles. This one, I can't go to a -1 on it. It's a 0 because that's what it is. But if you want to be short anything, I think tech is the place to be short. It looks like it has the worst performance of everything. We come to materials. Materials looks just like the market. We pulled back. We've gone under the 20-day moving average, and we had 2 candles where we tried to make a little bounce but failed. So +1 just like the market. And energy. Now, energy has definitely been volatile. There's no question about it. I mean, here we have Tuesday, huge run up. Wednesday, a gap up and a huge failure, just a huge failure. And then we have a gap up and a failure again. Look, this is not a great looking chart, but when we look at everything else, this thing has more of an upward drift than everything else. Everything else is drifting downward. At least this one, it's kind of drifting upwards. Very different from the rest. I'm not saying it's a great trade here. What I'm saying is when you're looking at things that are strengthening and looking at things that are weakening, it's telling you, hey, I'm strengthening. So the two sectors that strengthened this week, energy and utilities, they all strengthened. What got weaker? Well, we got comm services went from a +3 to a +2. But look at all the others. We've got materials, industrial, real estate all go to a +1. And then we got tech and consumer going to a 0. So you can see what really weakened the most, consumer and tech. These are where you're going to find the better bearish trades. Now look, if the market bounces, everything's going to bounce back up. That's just how it works. Some things will bounce back a little bit better. I still think tech and consumer are going to underperform in a bounce. I think this market is rotating away from those hot sectors of last year. Here we have our board. No question about it. Financials, healthcare. That's going to be the best looking sectors for long trades. I do like comm services. I know it's kind of crazy because I really hate technology here. I think tech is looking really terrible, but comm services is holding in there pretty good. And then we've got 5 sectors that are basically doing just what the market is doing. So let's go into some of these strong and weak sectors and look for some potential trades.
Have you been trading in the markets for at least 2 years? Are you starting to see some decent progress? Is that progress so small because of your limited account size? Maverick Trading is a prop firm that provides capital to profitable traders. You trade a minimum $25,000 account and keep 70 to 80% of the profits. After 2 consecutive profitable months, you move to a $50,000 account. As you keep progressing, you will be able to trade 6- and 7-figure accounts. To learn more about trading for Maverick Trading, either click on the Apply card in the top left, click Apply at the end screen, or click the link in the description to watch our recruiting video that explains more about Maverick and prop trading. If you like what you see, apply for a position and meet with our recruiters. Are you our next trader?
First one up, I've got utilities. Utilities was one of the sectors that got moderately stronger. So I'm looking for a stock that will also get moderately stronger. Remember, this is the utility sector. This is not tech. These things are slugs. They move slowly. And I mean, look at this one. 80 was this pullback, and it took about 2 weeks to get up to 84. That's about a 4.5–5% move. Yes, it can move quickly in one day, as we can see over here, but for the most part, this thing is a very slow mover. I'm looking for this thing to drift higher, but the question is, I don't think it's going to rocket higher. This is where a butterfly is a great little strategy to do. You can simply go in. Again, 85 is the midpoint. So I'm looking to do the 82, 85, 87.50 butterfly. And let me just show you the range that this is going to be. 82.50, 85, 87.50. I want this to be in the middle. So that 85 is the middle of this range. I'm giving it 2 weeks, the January 19th. I'm just saying, just drift up. Just don't go too far, but don't pull back and don't go lower. Again, a really, really solid sideways trade. Will it be profitable? Who knows? We'll find out. But does it fit all of the criteria for a sideways trade? Absolutely. Next up, comm services. This one surprised me. When I went out and looked, I expected comm services to be just like tech and consumer, just get wrecked, but it didn't get wrecked. And in fact, I tried to ignore this chart so much because I don't like to trade things like Meta, Amazon, Tesla, because these are the trades that whenever I see people constantly just trading those, I already know that they just trade what's in front of their face. And they don't use any sort of methodology. They don't use a screener. They don't use scanners. They don't, they have no focus. They're just like, oh, I'm going to trade Microsoft. That's very amateur. So when I come across this on my scanner, I try to ignore them because I don't want to be the guy that just always trades Meta or always trades Tesla. That's not how my system works. That being said, it is the best looking chart in the communication services sector. So I can trade it as long as I'm aware of it. I'm not just picking my favorites. Look, and it's not my favorite. I hate Facebook. It's not my favorite company. But take a look. We came down. We had a doji on Wednesday. Remember, the market got creamed on Wednesday. Doji. Thursday, the market went down. Hey, green candle. Look at this confirmation candle today. Look, this is a really good classic bull pullback. Now, let's remember where we are. The market is still likely to drift lower before it has a bounce. This thing is just looking good ahead of that bounce if it happens. I can't be super bullish on it. This is a +1 market. I do not think that Meta is going to go above 360. I do not think it's going to do that. So I think you need to be very moderate here. So this here is a pretty moderate bull call spread. If you want to be even more moderate, this diagonal call spread is really quite wimpy, because if you do the 345, 355, here's your risk graph. Again, this is going to be a really wimpy trade. 355 being up here. Again, it's not, you're not asking it to go past. If it blows past, if we do get that big bounce in a rally, okay, you'll make a little bit of money, but not a ton. But if this market like just hangs out here and just can't really go anywhere, a diagonal call spread is a really good place to hang out while it's just in this area. So you can look at the vertical spread, or you can take a look at the diagonal spread. Next up, healthcare. Hey, healthcare looks like the second best sector out there. Let's make a trade in healthcare. Here we have Teva. Now, Teva, we're breaking out of this high base. Now, a lot of people say, Rob, it already broke out of this high base. And yeah, it did. It broke out on Wednesday. Thursday, it got sucked back down with the market. But this is what I love. On Friday, remember, the market was not super bullish on Friday. Look at this candle. This thing wants to break higher, wants to move higher, and it did it on a day that was not so great. So what can we do here? Well, you can do a vertical spread. This one's going to be pretty aggressive. This one is going to be 25 delta. You can always do the wimpy one like I do. Here's the wimpy one. You're going to do the 10, 1150. So again, 1150 is just right up here. You're not asking this trade to go very high. You're doing a 10, 1150. If it blows past it, great. You're going to make a little bit of money. If it hangs out around this area, great. You're going to make a little money. If it pulls back, okay, then you've got your position management and your rules to deal with that. Financials are the best looking sector here. There's no question about it. They look great. Here's Capital One. Capital One wanted to break out today. It had broken out today at one point, but you can see that wick here. We got pushed back down because the market didn't really support it breaking out to the upside. There's lots of other financials that are breaking out. This one, to me, as long as the financial sector stays strong, this thing's going to 140. 140 is my target on this one, giving it 2 to 3 weeks. So how do you want to play it? Well, you can play it with the 135, 140. This is going to be fairly aggressive. Again, 25 delta on this one. Or you can be the wimp, like I like to be. Now again, the diagonal call spread is wimpy the first week. So again, the 135 would be where I was looking. But here's a great thing. After the first week, I can let that option expire and hold the long call and make it a much more aggressive trade. I can literally make a different change of this every single Friday. Do I want to roll to the next week, or do I just want to hold long calls? I love to start a high base off in a diagonal call spread and then shift to a much more aggressive strategy. And here we have tech. Now look, I would love just to go bearish on tech. I already have enough bears in my portfolio. I need to add some sideways. So here's Zoom. And I took a longer chart just so you can see where this thing has been. In the strongest markets, the best it could get was 74. In the weakest markets, the lowest it could get was 60. Here we are. Look at this pullback. We have had a gigantic pullback on this. So the question is, where is it likely to be? Now, I'm looking at two trades here. I'm looking at a 1 week trade, meaning I think it's going to be right about where it is. The stock closed at 66.96. This one is, we'll probably get weaker in the first part of the week and probably bounce back. So I'm looking at my weekly outlook saying, hey, I think we get weaker and then we bounce back. At the money butterfly is a great trade for this. If you want to go out 2 weeks, you can see I'm getting more bullish on this because I do think this market is still bullish. So I'm saying, hey, I think it probably bounces up into this 70 area. It's highly likely to have a bounce. If this market bounces, a targeted butterfly is going to be a great trade on that, giving you a 3-to-1 risk reward if it does bounce. And if it doesn't, then you position size for max loss, and you eat the loss and you move your capital onto other places. If you have any trades you want to share with the Maverick Group, log on to the Maverick Trading website, go to our forum. We always love to see our traders working together. The market is pulling back, and it still likely has some more to go. But everything in technical analysis is telling you it's just a pullback. Now, here's the irony, though. Every time a market tops out and has a trend change, the first movement, you will say it's a pullback. Oh, this is just a pullback. Yeah. You have to say, if you follow technicals, every single time you have an uptrending market, the first time it fails, you're going to say, oh, that's just a pullback. That's literally how it works. This first pullback will always be a pullback. We have to play it that way, because if you didn't, you miss this one, you miss this one, you miss them all in the past. Look, this one might bounce and fail. It might just fail. We don't know. But what we do know, just like seasonality patterns, just like the Santa Claus rally, if we play them all the time the same way, we'll have more winners than losers, and that's how you win the game of trading. So, any of you who want to get bearish, I can agree with you that there are some reasons to get bearish, but there's not any reasons technically, and you must trade technicals as a trader. Let's talk about this week. We are having a live session on the 11th. So every year I have a tax prep live session. I go through all of the possible questions that I inevitably get every single year. I do this video early in the year so everyone has everything they need. And then at about April 11th, I'll get 100 emails asking the questions that I answered in this video, and I'll just simply send them the link of the video, say, oh, thank you very much for your email. I already covered that. Please watch this. If you can't make it live, it will be recorded, but this will be a live session because there's going to be a lot of Q&A. And the Q&A is really where people find some of the questions that they have. Look at that sector rotation. Focus on where the money's going. There is still bull markets going on in this market. It's just not in tech anymore. It's just not in tech. It's elsewhere. Everyone have a great weekend. Take care and happy trading, everyone.